All right. Hello, everyone. This is me. I'm Guillaume Lambert. I'm with Amy Caldoun. We're both from I'm from Panoptic, but Amy's from the research team at Panoptic here. And yeah, this is Beyond the Greeks, IV and market structure on base. I'm very excited about this piece. We've launched on base last week. Base and mainnet definitely have differences in how they work and operate. And yeah, Amy will tell us all about it. I think we'll focus on Avi again and market structure. But yeah, first of all, Amy, how are you doing today?
Hello, do you hear me?
Yes, yeah, for sure.
Right. Hello, how are you? I'm doing well, thank you. All good.
Yeah.
I'm in Italy with my family. Very
How's the
productive day.
weather in Italy? Like, how's springtime there?
Uh, Not too good. We had like 2 good days and then the rest is all rainy, so we're pretty sad.
Oh,
Yeah.
yeah. I mean, I think I did some yard work. I'm in Boston. I did some yard work. There's pollen everywhere, flowers, even trees. I like
Yeah.
touched a branch. My whole arm was full of yellow. I think trees seed the clouds. You have these nucleation events, pollens floats all the way up, and then it's beneficial for them. They get water, but they
Yes.
produce a
Yeah,
lot
and
of these
so
small
many
particles.
allergies also.
Yeah,
You,
same
you know
here.
the theory about the trees in the cities? They
I don't
only
know.
plant male trees, not female trees, because the female ones they tend to attract bugs.
And then
So
for I didn't know that. Okay.
yeah, so you only have male trees everywhere, and they have like pollen, and there's no female trees to take them. So who takes them?
Oh,
The human beings.
I'm okay with a few bugs. That means less seasonal allergies for sure.
Yeah. So there's so much pollen, and human like the people. They're the one. They have the female trees role. So basically,
Oh my god! All
so
right. I mean, do both trees type do like flower produce flowers, or it's only the
I think
it's both?
only I'm not sure that like only female ones. I think
Okay.
but I'm not sure. Maybe there's some species that they do both. I don't know. But yeah, so like there's no, for instance, like you if there's no female trees, then the bees they won't like go around
Pollinate. Oh,
transporting
okay.
So yeah, so it was strategic, like because for cities, for instance, like Paris, they had a lot of both like female male trees, so they had to remove them because there was so much bugs and also not good for tourists. So
Oh, tourists. But yes, very. I mean, very cool. I'm pretty sure I saw there might be male trees here because lots of pollen. But yes, actually, so this is the intro.
biology live stream, guys.
Exactly, biology 101, pollen. These the I'm sure everyone all over the place suffers from these allergies. If not, you're lucky. But yes, otherwise, let's move to the research, which is Ethereum versus Base, a quantitative approach. But yes, take it away, Amy here.
Yeah. So let's start. So we launched on base not too while ago, and it was the perfect time to do good research on it and explain like the differences between Ethereum and base in terms of like quantitative perspective. So here it's important, like before doing any comparison, it's important to understand the structural differences between the two networks that we're analyzing. So here, for instance, Ethereum operates as both the execution and settlement layer with block times around 15 seconds and relatively quick finality. And also its deep liquidity and established role in DeFi make it kind of the canonical choice for institutional grade infrastructure. On the other hand, Base uses an optimistic roll-up architecture. It offers a faster transaction confirmations, like under 1 second, but differs at economic finality until data is posted to Ethereum L1. So this design allows for much cheaper per user fees thanks to aggressive data compression and batching posting. Base also benefits from its integration with Coinbase, providing access to like a massive user base from its integration to the centralized exchange, but it still lags behind Ethereum in terms of like DeFi maturity, and liquidity depth. So here, what's the implication? So Ethereum is preferred for deep liquidity access, integration with on-chain options protocols, for example, and Base is ideal for scaling custom dApps, aggregators, or like just retail-focused strategies. And as far as quantitative finance is concerned, so for building, for example, delta neutral vaults or real-time hedging tools or price infrastructures, here the distinction between those two is really matters because Base is ideal for low cost, high frequency compute tasks, while Ethereum remains kind of the go-to for strategies like that require deeper settlement security or like a multi-chain arbitrage, for instance. So yeah,
Exactly.
final quant take Ethereum equals finality, security, capital intensive execution, and Base equals scaling, cost efficiency, and latency optimization.
Yeah, very good summary. And I don't think we've seen it yet, but then, yes, Base and some of these rollups, they have a centralized sequencer. If it goes down, you can imagine the whole chain being paralyzed. Of course, they do a very good job, but at least the security slash yeah, backing of Ethereum makes it a bit more safe, I'd say, for institutions and yeah, high value transactions. This is kind of the new meta, but high value transactions could go on Ethereum, but Base is good for scaling. So this is very cool.
Yeah, exactly. So moving on to the next. So one way to quantitatively compare both chains is to compute their volatility. And what's better than implied volatility, right? So we computed IV across both chains. So on Ethereum, USDC 5 APS pool, which is supposed to be the most liquid. And here to see like the differences better. And yeah, so for general observations, both we can say that both Base and Ethereum IV follow kind of a similar macro volatility cycle, which indicates that they respond to the same market shocks, which is good because we don't want we don't want it to be otherwise, right? Imagine.
Or it could be an arbitrage opportunity. Maybe this is what we see as well. But yeah,
Yeah,
the I'm actually somewhat surprised that they match so well. But yeah,
yeah,
that
they
makes
do.
sense. Yeah.
Mm. So Base here we
This
can
is
say
both
that,
the sorry the both 5 bips pool
yeah,
on Uniswap.
5
Okay.
APS pool, yeah.
Yeah.
So Base, we can see that it's like consistently more volatile. We have like wider dispersion as well, which reflects either we can name like lower liquidity or more aggressive trading or more frequent price manipulation. Like we can think of just in time the JITs that we like to call them. Whereas here, Ethereum IV appears like smoother, more clustered, which suggests just overall like liquidity, like good higher liquidity and kind of a little bit of stability as well. I'm kind of cautious like with the word stability, like using it, especially in like the crypto space. Like, what do you think?
I mean, liquidity is ultimately the main driver for all of those. And if you want to, the stability is maybe predictability. You want to be able to trade 1 ETH or 10 ETH or even 100 ETH and know that you'll get a pretty good price. And if it's, yeah, and I would say that the more liquid there is, the more ways like liquidity can backstop larger trades, then this is mostly better, and that helps reduce the volatility. We've done some with Deribit, and Deribit has billions of dollars of liquidity, way more than Uniswap. In that case, also the IV is a lot more stable. So that's,
Yeah,
I mean, just the relationship with how much liquidity is there.
yeah, exactly. That's a good example with Deribit. Definitely. Yeah, so here we see like spikes that exceed 400%. Ethereum rarely breaches the 300 mark. So here we can which signals kind of like a higher tail risk or like more reactive volatility surface, even though the volatility surface on Base, I think it's gonna be like less reactive than Ethereum when you think about it. But yeah, so overall they match, but the spikes on Base are way higher than Ethereum's. Also, on the other plot, the second plot, where it shows the IV difference. So I just computed the difference between base IV and Ethereum IV. So we start with base and then Ethereum. So it shows that generally speaking, it oscillates around zero. So that's the average difference. It's zero. And we want to say that there's like a negative bias, which suggests that Ethereum IV tends to be slightly lower, but like overall, we can just say that like there are some deviations that hit beyond plus or minus 100%, which implies something that we call temporal inefficiencies, or like what you said before, arbitrage windows between base and Ethereum IV. Uh, Also, one thing that I thought about while doing this, like I thought about my time series class back in my master's. So one word that came up to my mind when I saw that the spread, like the difference between IV in both chains, is that the spread is heteroscedastic. That's like
That's a
one,
mouthful. Yes.
which means that so by heteroscedastic, by the way, it took me a year to be able to say that word.
How do you say it
So
in French?
it's the same thing, heteroscedastic, I
Okay.
think.
It shows up every once in a while in the options textbook and realm, but yeah, I'm sure even if you're taking statistics, I'm not sure you get to heteroscedastic. I
Yeah,
don't know.
so
Yes.
it's one of those complicated words where when you translate them into like other languages, they don't change much. It's so complicated that you just don't you just want to change the end of it. So yeah, so this word means that generally speaking, it means that the variance or like volatility of a certain variable that we're analyzing is not constant over time. It just changes depending on certain conditions or like across observations. So here it's the same thing. So we have the volatility of the spread that increases only during periods of market stress. So here at the beginning and at the end of our period of our 3 months. So that's basically what it means. And also from another quantitative perspective, we can say that there's like a mean reverting spread that's created, which is relative value to trading opportunities. So for example, one may go long IV on Ethereum and short IV on base during volatility spikes.
Which you
So
can
yeah,
only do on Panoptic, by the way. And yes, otherwise it's probably a slightly different way. But yeah, very, very cool.
exactly. Exactly. So moving on to the next slide. So here, this slide highlights the price basis between like base and Ethereum for the same ETH USDC pair on the 5 EPS pool. So it's one question that you ask, right? Like, okay, we have one asset which is ETH, and we want to see the difference of its price in both chains. Does it change much? Does it not change? So it's important to know that also when you want to do some strategies on top of that. So we can see that. So we have our period is from January to March 2025. So on the left, we see that the spot price of ETH USDC steadily decline over time. So the small graph is actually both prices, for both chains. So we have the price of ETH on base and the price of Ethereum on of ETH on Ethereum. It's getting confusing. So you have like a transparent orange color. That's because they actually like collide. So it's supposed to be like one orange, very orange. The other is pretty much gray. So since the prices seem to match, that's what you get. And we want to see like we want to zoom in the difference. So we did the same thing that we did with Ivy. So here we took the price, the difference, and we display it. So here what stands out is that we have like a presence of short-lived but extreme dislocations of like prices exceeding plus or minus 150 USDC. So these we can call them just transient spreads. They're not permanent. They just appear once in a while.
So yeah, maybe this is a bit surprising to me. Let me get my face back in there,
Okay.
but it's it's actually pretty interesting. I think. Oh wait, I'm gone. Show camera. There we go. Yes.
Hello.
Actually, yes, hello. This is like $150 of price difference between base and Ethereum.
Mm,
And that is actually a huge, huge amount. But I think it's because of the block time on Ethereum.
yeah, that's
It's
one
one of
thing.
those extreme drops that within a few seconds could drop 150, 200, 300 plus. We've seen those in crypto every other day, it seems. And
Yeah,
yes, that 1 minute has a huge discrepancy because the price of ETH is catching up way, way too late than Base, which has a second by second update time. And if you're thinking about this, this is what people complain about with could be LVR or like arbitrage opportunities. But if you are a MEV bot, a searcher, and you say, aha, price on Binance, price on Base is $150 off. Let me trade this, arbitrage this away. But yes, now you can actually be the first in line by paying a fee to get your transaction included. And that is again because of the binning of the blocks on Ethereum is kind of long. If we were to do Bitcoin style 10 minutes, then that delta could be 1,000. I mean, maybe not 1,000, but $400 depending on how quickly the price moves. And yeah, this is uh, it's not that ETH markets are wrong. It's just that they are delayed, and then
exactly.
you see this up and down. It seems like where it could go both ways when it goes up or down. But yeah, you just have this delay that needs to be arbed out.
Yeah, for sure. So there's definitely like two things: either the jet liquidity behavior or the cross-chain latency. So one of the two,
It could be
or
also
like
fat fingers. If someone trades 1,000 ETH, they may push the price in one transaction, and could be only on Base, only on Ethereum, and then now it's hard back again because the fat finger didn't care about execution type of thing. But yeah,
yeah, for sure. Yeah, so yeah, all in all, we can say that for like traders, quants, this kind of has like a real implication. Like these price gaps can introduce, we can say, like execution risk, arbitrage opportunities, or like some kind of distortion of PNL, especially if you're delta hedging across chains. So it's like a constant reminder that even in DeFi, like latency and liquidity structure, they can still create some kind of inefficiencies like we see here, which needs to be modeled and like just taken into consideration, obviously. So yeah, great. Now let's move to the fun stuff. I mean, we've been doing fun stuff so far, but this is even more fun. For me, it wasn't because computing this thing took a long time. So my computer is like resting in peace. But yeah, so I, we, the team, we did compute the bullish and also bearish strategies on top of, again, the same pool, ETH USDC 5 BPS pool, on both base and Ethereum to see if there's like any changes in terms of accumulated returns. And do you want to take over? Because I see your eyes like going everywhere.
no, exactly. I mean, this is very dense, but I think it's a we will do this more and more, and then that's something people will probably see often. But
Yeah, for sure.
we're comparing like there's four different ways to trade options: buying a put, selling a put, buying a call, selling a call, and then we test all of them with our back test. And I don't know if we see the time. It's like since the beginning of the year or something, or
Yeah, it's just 3 months. Sorry about like it's a little bit small. I didn't want to do it over again because it took so much time. So
no, no
so
worries.
yeah, so it's 3 months, guys. 3 months from January 2025 up to the last day of March 2025. And it's we are using monthly options which are out the money, so 30 deltas. And on top of sorry, on the ETH USDC 5 EPS pool. So that's the main data that we're working with.
And the key point is that the green line is what your kind of wallet shows, which is kind
So,
of wait, is it the green line?
so the green line is the payoff. The pink line is the returns, net
I see.
returns,
I see.
and the purple one is the premium.
Yeah, I see. So the key point is that uh, the it's losing every started losing. Which one is the total return? The pink one?
So the net returns is the pink one. Yeah, just look at the
Okay.
pink one. The premia is also what's interesting because if you're a seller, that's what you receive, and if you are a buyer, that's what you give to the seller. So that's
And
also interesting if you want to like look at that in both base and Ethereum chain.
yeah, so the key point is that the beginning of the year was definitely bearish, and I would expect that buying puts would have been a bit higher. I don't know, but yeah, turns out that or maybe it's flipped, but yeah, the directionality matches the historical market conditions, but the premium, which is kind of what you get or paid, is what you can actually think of the real returns. You can hedge, you can actually do delta neutral, and if you're dynamically hedging, you can actually just collect that premium. And yeah, so I think this is the ETH. Our faces. This is the ETH backtest you said, or this is the base one?
Yeah, it's both. So you have so on the first row, it's the base network
I
for the same strategy, and then the second row is the Ethereum one for the other strategy. So
I
for the first one is the short put,
I see.
right?
Both bullish
Or
strategies lost a lot of money because price went down, and then the key point is that the returns are matching a little bit. But yeah, this is
a
kind of
little bit. So
yeah.
yeah, so base offer like a kind of slightly higher returns. So we have like plus 17, and the other we have plus 14 for Ethereum. Um, and yeah, so that's like for the bullish long calls. On the other hand, they seem to be underperforming, which makes sense because the 3 months period of Ethereum is bearish. So like as we saw on the previous slide. So I used the same period to compute the difference of the ETH prices between the two chains. So we can, if you want, we can go back to it and see like it's declining over time. And yeah, so for the bullish, so we can say that we have higher returns, generally speaking, like the general observations, higher returns in base than compared to Ethereum chain. And they both, under the long calls, both underperformed, delivering like negative returns, which is like the limited upside failed to cover like the cost of the premiums. And we can move to the bearish strategies, which is supposed to be like the most interesting one since ETH is declining. So here, I
Hmm.
don't know if
Yeah, yeah.
or that,
The left is the short call, and then on the right is a long put. And the key point is that the green lines should match because the price matched quite well. And the main difference is the amount of premium that you collect or get collected. And I'm a bit surprised by this, but it turns out it seems like the base returns are in the pink lines are higher for base than Ethereum mainnet. That means that's why the net return is higher. But yeah,
exactly.
if you were selling calls or buying puts, over the last 3 months, which is or 4 months even because of the price went down, you make money, but then you would be getting a bit more returns on base if you sell options, but you pay a bit more if you are on base as well. So that means that the buying option is probably overperforming on mainnet and underperforming on base.
Yeah, and payoffs. That's the most important thing that you said. It's they're both the same. I mean, they're supposed to be quite the same, because obviously our way of pricing is supposed to be consistent in any chain. So yeah, so it's not bad actually. Like we still have like a little bit higher returns. I mean, it's interesting. Like when you see 4% more, it's interesting when you have like obviously like a bigger capital. So 4% on 1 million is not that bad compared
Exactly.
to 4% of like 1,000 euros or 1,000
Yeah,
USDT.
I would imagine that the liquidity on ETH means that to some extent you may scale a bit higher with these larger position sizes, whereas on base there might be a bit less. So again, if you're cornering 80% of the market, then some of that edge may vaporize.
Yeah,
But yeah, it seems like it is coming back to what we saw, like something that, yeah, to keep in mind for sure. Base may have slightly higher IV for some of these, which is what we saw. Even, yeah, we saw it in the previous slide, which is this one, I think. Yeah, base has a maybe higher one. So higher returns, very cool.
Yeah, exactly. So yeah, so these are like last conclusions. So we can say that Ethereum works better for long volatility trades, and base on the other hand favors like short volatility strategies since premiums are like higher, and yeah, and payoffs were the same on both chains, showing that our path price path is consistent. And yeah, so that's it, I think. I had something else to say, but I forgot it, and it's because I need to eat. I haven't eaten,
Oh,
but I forgot. I'm getting old, guys.
you forgot
So
to eat at dinner time. Is it early? Yeah,
no,
in
it's just
Italy.
like it's 5:30, but like my cousins already have their snack time, because in Italy, like snacking, the snack time is very pretty precious.
Oh,
So you don't want to miss that.
my kids also don't want to miss snack time. Otherwise,
Yeah, I
it's
mean, yeah,
World
it's
War. Yeah, at home.
exactly. So yeah, so this is for our base and Ethereum comparison. I hope you had some value from it and some insights. I mean, it's always interesting to do like these kind of comparisons, and in terms of like prices or volatility or premia returns or anything like that. So yeah, so stay tuned for the next ones, and
Exactly.
we have plenty of research for you, and plenty of insights. So yeah, that's
Very
it.
cool. Yeah, thanks so much, Amy. And again, maybe the TLDR could be not financial advice, of course, but buy on mainnet and sell on base. Be one of those arbitrageurs if you want to. It's easier to sell, so definitely the selling part is going to be easy, and buying just have to look for opportunities. But yeah, there's definitely a lot on Panoptic. But yeah, thanks so much, Amy. This was great. Thanks for the research. And
Thank you.
all right, thanks everyone, and I'll see you on Wednesday. Amy, again tomorrow we'll be doing the what's the title of the segment again?
Yeah, so the title is I'm going against our CEO, so I'm going against you, Guillaume, and I'm gonna give you all the myths, misconceptions, or like ideas around trading options, just options in general, and you're supposed to either correct them or like give your opinion, or like I don't know, just like share your insights around that. If that's true, that's true. Is it half true, half false? So yeah, so basically I'm just like gonna be against you.
Exactly. Looking forward. I don't even know the questions. My answers will be
Yeah,
about Vama the whole time. But
that's
yeah,
true, by the way. We're
I'll
not
keep
just
it
saying
simple.
that, but it's true. I haven't shared any question. So yeah,
All right.
excited
Thanks
to
very
try
much,
that.
everyone.